Well, hi everyone. Welcome to the Buffett and Beyond Research Stock of the Week, and we're going over some stocks that we talked about during the past week or two, and that is our dividend growth and income portfolio. And folks, O'Reilly is one of those stocks in there. We're going to show you exactly why we're saying this stock is up when the market is down. We're going to show you two examples of that. And remember, folks, if you want to walk on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And O'Reilly Automotive, well, most of you know what it is, but they supply aftermarket auto parts, tools, equipment, and accessories to both do-it-yourself, DIY, customers, and professional mechanics or service technicians. And it also offers services including used oil, battery recycling, and wiper bulb replacement. As of December 31 of 2023, it operated over 6,000 stores in 47 states, Mexico, Puerto Rico, and it had about 90,000 employees, wow, including 14,000, almost 15,000 part-timers. Now, I want to show you, last time we went over this stock to when going over this stock today, and there has been a difference because O'Reilly, now we're comparing O'Reilly in green, and blue is the average stock in the S&P 500. So we're looking at the clean surplus ROE, and last time we went over this stock, 4 or 5 months ago, we saw that it had a higher clean surplus ROE than the average stock out there. Now this is for the dividend growth and income portfolio, so the clean surplus ROE is not as restrictive in this portfolio as it is in the growth portfolio, because this is also a defensive stock, and that's the purpose of why we're showing you this today. And again, we're going to show you two examples. So since we went over this, we can see that the ROE has dropped down from 19.7% down to 17.9%. So there's a little drop there. Now, the average stock has a net income of 13%. O'Reilly had a net income of 14.7%, but now down here you can see the net income has dropped off to 10.2%. Revenue, average stock 7.1. O'Reilly was doubling, more than doubling, the average stock at the revenue of 15%, and today the revenue has fallen down to 12% per year, but still almost doubling the average stock out there. So as long as that revenue keeps coming in, this company can bring that to the bottom line. And of course, now we're having problems with the tariffs on certain automotive parts, etc., etc. So we'll see what happens when it plays out. But it is not bothering the market one bit because of its defensive nature. Let's go there. So we can see that the net income is rising, and these are the clean surplus earnings. So it's the earnings minus all non-recurring items, such as stock options that are given to management to lure them to work for the company, lawsuits, and maybe sales of some of the properties that they own, but they lease most of them out. So net income is a pure number that we could use to compare one company to another. In other words, what is the business itself doing? And we can see that clean surplus ROE was nice and high in the 20s, and then lately has been falling off and expected to go down a little bit back into 2026 from this year, 2025. Retention rate is great because it takes all the money it makes and puts it back into the company in order to grow. Almost no debt. It takes just 2 years to pay off the debt. Buffett's rule of thumb: if the company took all the money it was making and invested it back into itself, how many years would it take to pay its debt? His rule of thumb is 5 years or less. Our rule of thumb is 3 years or less. So it could pay off its debt in 2 years, which means that an increase in interest rates doesn't bother this company very much. Pays no dividend, which means it has a retention rate of 100%, and we like that. It's investing all the money it makes, so we like that in a company. Now let's look at the last 12 months. Last 12 months, black line is the S&P 500, and this yellowish line is O'Reilly. So look in here, when was this? About March and April, beginning of May over here, where the market went down just about 20%. NASDAQ went down 30 some percent at this particular time in here. Look what O'Reilly did. If you take it from this point this point right here where the market made a high all the way to this point here, this stock actually went up. Look over here. As the market went down, money was piling into this stock because it's a defensive stock. So even though your portfolio was going down, this stock was going up. And that's why we have this stock in at least two of our portfolios, folks, because we like it that much. Then when the market started going up and earnings started coming out, this is what happened since last time we reported on this big jump in stock price up here. So folks, we kind of like this stock over the last 12 months. Now here's something that's going to surprise you. Past 5 years, black line, the S&P 500 up 90%. This stock up 240%. So we could see that this is not only a defensive stock, it's also a growth stock. And what better kind of stock to have in your dividend growth and income portfolio, and also our income portfolio. We like to put a little safety in there. But this is really what I wanted to show you. 2022. Right in here is when the market, the S&P 500, dropped 19.6%. The NASDAQ was down 34%, so all the way down here. What did this stock do? What did O'Reilly do when the market went down that whole year over the 19.6%? This stock went from here up to here. Oh my gosh. Now don't forget, where is our growth portfolio? Our growth portfolio is right around up in here, in this point here. So O'Reilly is not only a candidate for our dividend growth and income portfolio, but it's a candidate for our growth portfolio. And I shouldn't say candidate because it's in there already. So yeah, our growth portfolio is all the way up here. O'Reilly is right there with it. And here's the S&P down here. And remember, over any 10-year period, 96% of professional money managers who manage those publicly traded mutual funds, 96% cannot outperform this black line here. So it's almost necessary to have this stock in your portfolio. Now here we have another statistician, and this is, they say, is now the time to buy O'Reilly, because remember we showed you the one chart where this thing is up 240%. Well, O'Reilly's stock price right now about $103 implies a valuation ratio of 33 times its forward PE ratio. Now that's pretty expensive. So what they're saying is this may not be an obvious bargain, but you still stand to generate a nice return over a multi-year investment period. So if you like the business model, in other words, if you like the business model of a company being defensive and growth at the same time, and believe the bull case, we like that growth, you can own a smaller position. Of course, our work, meaning these statisticians, shows that high-quality companies outperform the market over a multi-year period regardless of entry price. And that's very, very important, folks. So yeah, we like O'Reilly Automotive at almost any price, and it's been in our portfolio for a long time now. And I'm looking at it between O'Reilly and AutoZone. We've had at least one of these stocks in our portfolio for over 22 years. So that's how much we like this stock. But we're not afraid to sell it if we think it becomes overvalued in one area or another. We're not afraid to sell it. So folks, we had a pretty good week this past week. We like it. And you want to go out, you want to be safe, go for a walk, get your mind off the market, because guess what? It'll be here next week. So folks, go out, be safe, be with your loved ones. We'll see you right back here in a couple of days.